Today's episode is brought to you by Curve, a card and digital wallet service. You'll be hearing more about Curve later on, but for now, let's get into today's interview. I am joined once again by Kemen Linsuain, also known as DC Analyst. Kemen, welcome to Forward Guidance.
Hey Jack, thanks for having me back. It's great to talk again, and I see a lot going on in the markets. Kind of Fed meeting yesterday, as we're recording here. So, excited to jump in and talk about rates and kind of update on everything that's happened.
Yeah, me too. So you are a polymath, not just in sort of Fed lingo, central bank lingo, but really the plumbing, the tri-party repo, the LIBOR to SOFR transition. So we're going to get in all of that. By the way, your day job is at a crypto firm named Gauntlet. So we can talk about DeFi at the very end of this episode. But I want to pick your brain just about, what's been going in markets. What has stood out to you this year in terms of the plumbing? Like, in what way are the financial markets different?
Short-term rates have gone up at a tremendous amount since the start of the year, and that's kind of the most obvious thing to everyone. But also the other thing is that for the past kind of 2 years, 2020, 2021, the kind of short-term rate space in terms of spreads was very, very quiet because their rates were mainly at zero. There was a lot of cash in the overnight markets, a lot of cash in the short term markets, and all the spreads were basically compressed, very low, and not doing much of anything.
Spreads between what and what?
Okay, so can get more specific there. There are a lot of spreads. So I think one of the most important ones we'll talk about today is probably SOFR to Fed funds. But this applies to spreads in general. So like SOFR to euro dollar, SOFR to Fed funds, SOFR to cross currency swaps, commercial paper, kind of term rates. So for the past 2 years, I would say prior to this year, most of that space was just very quiet. Everything was close to zero. Fed was doing QE, was keeping rates very low, and nothing very much of interest was happening in terms of the spreads. This year, that's not the case. So we see now within kind of the range of the Fed funds target, the Fed policy target range, the range itself is moving up, but rates are also moving within the range. So that is interesting and important, and that's a change in the dynamic this year, and makes kind of trading and what's going on with rates this year much more interesting, since there's actually something happening.
All right. Okay. So Fed funds is what the Federal Reserve officially controls, and when they say, "Oh, we're hiking interest rates, we're cutting interest rates," that's what they're really talking about. Even though most of the action is actually in the reverse repo, which we can get into. But so what is SOFR? And you said euro dollars, that's LIBOR, and soon LIBOR will be no more. So talk us through LIBOR, SOFR, and Fed funds. Fed funds stands for federal funds. SOFR, secured overnight financing rate. LIBOR, London Interbank Overnight Rate. Offer rate. Thank you. Because when people say, "Oh, interest rates," I think rates are going up, I think rates are going down. It's generally these things move together, but they're not the same thing. And if you really want to acquaint yourself with the intimate details of these things, then you got to know the difference.
Yeah, very much so. So you mentioned three different markets. So Fed funds, which is an unsecured overnight onshore market, then SOFR, which is the repo market, which is also onshore. Also overnight, but it is secured. So there's collateral involved. And then there is LIBOR, which is different in a couple ways. So LIBOR is offshore. It's in London. It is unsecured. So there's no collateral involved, and it's term. So it's not overnight. It's 1 month, 3 months, some period into the future. And so these three kind of separate money markets exist. And then there are derivatives of all of them. So there are these three markets. So we can start with the Fed funds market, I guess, which is the official policy rate of the Fed. And that is onshore and unsecured. So the banks are lending to each other with no collateral within the US. So these are all banks that have accounts at the Fed and are transferring reserves, lending them to each other overnight. In a way, this is kind of an interbank deposit system since, well, the bank is loaning reserves to the other bank. That's, in a way, kind of the same as like having a deposit at the other bank. In the past, before the global financial crisis, this used to be a very big market because there was relatively low reserves in the banking system. The Fed's balance sheet was fairly small, so these reserves were scarce. And as like payments occurred during the day, banks needed to move them around a lot more. So they would lend them to each other in the Fed funds market, and that market was really big. Nowadays, that's not the case. There's much more reserves in the banking system. The banks don't really need to redistribute them as much intraday to meet their payment obligations. So the Fed funds market has gotten a lot smaller. It's still the official policy target, and there's still some daily activity, and we can kind of go into this in more detail. Certain banks do keep their cash in this interbank unsecured market for kind of regulatory reasons. So that is mainly Fed funds. Then we can get into SOFR, but to talk about SOFR, I guess we have to talk about the repo market a bit more, but can pause there and kind of get more, clarify more direction there.
So when you said the banking system now has way more reserves than the banking system before the Great Financial Crisis, correct me if I'm wrong, but we're not talking twice as many reserves, 3 times as many reserves. I think it's like 30, 40, 50 times as many reserves, right?
Yes. Yeah. So
way more.
Yeah. So the difference there is, well, in the past, before the GFC, reserves were also not remunerated by the Fed. So the Fed did not pay interest on reserves. So that in that case, for rates to remain at like kind of a target equilibrium, reserves needed to be pretty scarce since the natural rate that they earned was 0. And that means that like if the Fed funds rate was say 3%, that 3% was entirely kind of a premium due to the scarcity of these reserves in the market. Nowadays, that's not the case. The Fed remunerates reserves. So now, as of the latest rate hike, it pays
425 to 450 in that range,
right? IOR. So for 35% on reserves, and then from there, it's even though like reserves are much more plentiful, the market rate of reserves is much closer to that value because, well, the Fed is already paying interest on them. And this kind of gets into the current role of the Fed funds market. So currently, the Fed funds market is mainly an arbitrage. Actually, more detail. There's 2 parts to it, but the main part is arbitrage. So some banks, these are the federal home loan banks, which are government sponsored, do not earn interest on reserves because, there's kind of various legal reasons for this, and also it's kind of pointless for the government to pay itself interest. So that means that they can't do reverse repo. They can't get IOER, interest on excess reserves, like. Well, they can do reverse repo actually, and they can participate in the repo market, but they can't earn IOER. Yeah, exactly.
Okay. So they can't do IOER, but they can. So, but why wouldn't they just put it in the RRP?
They can do that, and the RRP rate is a little bit lower than IOER. But usually, what they do is they keep their cash, their reserves in the Fed funds market. So they just go to the Fed funds market every day and offer however much liquidity they have or they're willing to part with overnight. They offer it to all of the banks, and the banks quote them some level that is a little bit lower than IOER usually, and that's a good arbitrage for the banks that are taking this excess cash from the FLG.
Okay, so thanks. So there are three levels at the top, which would, so now the target range for federal funds is between 4.25 and 4.50. So you just said, let's pick up, the effective actual Fed funds is 4.35. Interest on excess reserves might be 4.4, and repo might be 4.3. So it's like a tiered stack where the home loan bank can't get to the top of the stack on interest and excess reserves. So they lend money to banks who can do it. So banks borrow at 4.35% and then deposit at 4.40%.
Yep, exactly. So there's three levels, right? So there's the RRP, which is like the lowest level of rates. It's always been, since the RRP has been created, it's always been kind of the lowest offered rate from the Fed. Then there is the IOR rate, and then Fed funds is somewhere in the middle. So the federal home loan banks cannot earn IOER, but they can get close-ish by lending to other banks.
Yes, and then there's another level. So at the bottom is reverse repo. Well, at the real bottom is the lower effective Fed funds rate, and then reverse repo, then Fed funds, then interest on excess reserves, then actual repo rates. Again, the reverse repo rate is what the Federal Reserve pays banks for. Basically, you can deposit or you can lend money to the Fed, not that the Fed needs money, and they give you that rate. Repo is if banks want to borrow money from the Fed and post their collateral, their assets as collateral. And then above that is the upper federal funds range. And then when you have the repo rate go above the Fed funds rate, that's when you have a liquidity crisis like you did in September 2019.
Yeah.
Okay.
So the other kind of detail here, and I guess most of these things are in the latest post on my blog. So that is DC's chartbook.substack. But as I kind of went into in that blog post, the market rates. So Fed funds and SOFR, they are kind of not point lines, they are distributions. So there is kind of some range of rates that the market actually trades at. And like the federal funds and the SOFR rates that are reported to us as like the headline numbers are the medians of those distributions. So there's a median, which is kind of the official reference. And then around that, there is some dispersion of like actual market trades. Mm-hmm. And from the data, like the Fed, when it reports these rates, it gives us some percentiles, so we can know kind of where the extreme parts of this range are, and sometimes the kind of distribution of the rate, the ranges changes. So in some market conditions, there might be a skew, like there might be a few banks that are in the Fed funds market, for example, borrowing above IOR because they are not doing this for arbitrage. They actually just need the reserves. So they temporarily kind of go to the Fed funds market and borrow some reserves that they're short of for a little while. This is not usually kind of a reliable ongoing funding for banks, but there are some banks that borrow in the Fed funds market for real funding needs. And that affects the distribution of the federal funds rate. And that causes kind of this bimodal behavior of it, where there are some banks that are doing one thing and some banks that are doing something else. So that's another kind of detail within the kind of behavior of market rates within the Fed's kind of policy range.
Okay, right. And so the repo rate and both the reverse repo rate, are they both SOFR rates?
So this is another thing that kind of go over in the blog post. So the repo market is actually made up of many different parts, and not all of these parts are entirely observable. So there are certain institutions within the repo market which are kind of very large and have a huge market share. So namely, that is BNY Mellon as a tri-party agent, and the Fixed Income Clearing Corporation as a clearinghouse. So they provide, BNY Mellon provides kind of custody and like collateral monitoring for repo participants. The Fixed Income Clearing Corporation provides like netting of transactions and central clearing. And all of the repos that go through those two venues are more or less observable. We can see the data on them. The Fed reports statistics. But like besides that, the repo market is very decentralized to some extent, and we can't entirely know what's going on. So this might be just a small hedge fund going to a dealer and saying, "Oh, I want to do an OTC repo trade," and they talk through a Bloomberg chat or on the phone, and they do the trade on the dealer's books, and nobody really knows about it. It's not reported. The Fed doesn't include the rate in SOFR. So SOFR as a repo rate includes some segments of the repo market, which are mainly processed by these two very large central counterparties. But it's not the entirety of the repo market, and also it does not include any transactions with the Federal Reserve. So in this kind of design of reference rates, the Fed excludes any trades that it itself does. So the reverse repos coming into the Fed, or if the Fed is doing repo operations, those do not show up in the reference rates, other than the fact that like they influence the rest of the market, but they're not like directly included in the calculation.
Right. Okay. So there's a lot of buckets for the repo market. There's tri-party repo, which is you have a counterparty, either BNY Mellon or the Fixed Income Clearing Corporation. Then there's bilateral repo between two parties, and that's very hard to observe, pretty much impossible to observe. I mean, you can observe the volumes. I think you have a chart on that, but not much more than that. And then what is sponsored repo? Yeah.
So there is... within these several buckets, there are. So I think the way to actually distinguish the buckets is like, what do the central counterparties do? So BNY Mellon is a tri-party agent, and what that means is if I were to do a repo with you and we were to use BNY Mellon as a tri-party agent, we would both have deposit accounts at BNY Mellon, and we would have our collateral custodied by them, and all of the transaction would occur on their books. It would be cash moving from my deposit account to yours, or vice versa, and like the collateral staying custodied by BNY Mellon, but just moving from an account in like my name to yours, or vice versa. So that is the role of a tri-party agent, and then a clearinghouse is a little bit different. So the Fixed Income Clearing Corporation is a clearinghouse. It nets trades. So there are many dealers that are members of the clearinghouse, and they do a lot of trades with each other during the day. And those trades, if they needed to all immediately settle at their face value, would create like a huge amount of settlement volume. And for the sake of efficiency, the dealers that are members of these of a clearinghouse can cancel out trades that offset each other. So that's kind of the two different roles of a tri-party agent versus a clearinghouse in repo. And within the buckets, there are overlaps. There are some repos that use one, don't use the other, that use both, that kind of all the different combinations are in there. So coming back to sponsored repo. Sponsored repo is a special program that is offered by the Fixed Income Clearing Corporation, where hedge funds that are not dealers or that are not members directly of the Fixed Income Clearing Corporation can, through their dealer, execute netted trades as if basically they were members. So like the hedge fund's broker is effectively a member of FIG on behalf of the hedge fund they serve and nets their trades on the clearing.
Okay, that's really interesting. But then zooming out, so there's bilateral, tri-party, and then what's the third type with the Fed? Where is the Fed? What bucket is the reverse repo facility in?
So the Fed actually does tri-party repos. When these facilities were set up, the Fed decided that it would be best to kind of use the standard infrastructure, but that is used by by large part of the market, and set up an account with BNY Mellon, and whenever they lend cash in repo or drain cash from the reverse repo facility, they do it through those accounts. So that is a tri-party repo. Those are not included in SOFR or the reference rates. So those are very much part of the market, but not included in the calculation.
Hey there, I hope you're enjoying today's show. Just wanted to let you know that this episode is sponsored by Curve, a payment service that gives you power over your finances. The way it works is that Curve is an extra layer on top of your credit and debit cards that gives you additional cash back on the rewards that you're already earning. Curve Card has no foreign transaction fees, and you can choose to earn your rewards in crypto. You don't have to, but you have the option. Curve Card also has a feature called Go Back in Time, where you can retroactively change the card used to buy an item after you made the purchase, up to 30 days after, actually. A key concept in finance is optionality. When you have the option to do something, but you don't have to do something, this can be very valuable in finance as well as life. And optionality is exactly what Curve gives you to do with your wallet. So check out Curve. Go to fgpodcast.link/curve to get $20 once you've downloaded the app and made your first transaction. Curve Card is powered by Hatch Bank. Terms and conditions apply. Now let's get back to the interview. Okay, so this is very complicated. Let's move on a little bit to SOFR. So it's secured, but it's secured by what? General collateral is collateral that's like normal, as in like everyone trades in it, right? Like a 2-year Treasury note, or maybe a very on-the-run mortgage-backed security, right? Or right?
Yeah. So there is also that's a good point. So there's a distinction between general and specific collateral. So a repo is kind of lending cash against treasuries, but obviously there are two sides of that trade. So one person gets cash and one person gets treasuries, and the motivation for doing the trade may come from either side. However, in this case, like if someone wants to use a repo to source a treasury, they usually want a specific treasury, and it's usually a fairly small number of specific treasuries. So this is like comes back to the on-the-runs and the cheapest to deliver issues. So within the Treasury curve, there are a certain small number of securities that are the most traded. Usually those are the most recently issued, or the ones that are referenced by futures contracts. So people are trading futures on treasuries, and the underlying treasuries are usually much more liquid also than the rest of the market.
Right. So a 10-year treasury is issued today on December 15th, 2022. In a year, on December 15th, 2023, it's not going to be a 10-year treasury anymore. It's going to be a 9-year treasury. And people buy and sell fewer 9-year treasuries than 10-year treasuries. 10-year treasuries is the benchmark. And if you're buying treasury futures, that's what you're trading. So it's like it constantly moves back a day. The duration is constant. So if CME, the Chicago Mercantile Exchange, if you buy a 10-year treasury future, they're short a 10-year treasury future. So they have to hedge that with a real 10-year, right, security, or someone on the other side has to. And the way they have to borrow a 10-year treasury note, and they don't want 9-year treasury notes, they want 10-year treasury notes, right?
Exactly.
Yeah.
Right. So if and this is actually a very big part of why this happens is people are trading treasury futures, and there is a certain small number of securities that are deliverable into those futures, and there's even usually just one specific one that is obviously the cheapest or the most favored by the contract to be delivered. So people want, if people are hedging the futures contract, they want to hedge it with that bond. They don't really want any other bond. And in the repo market, the way this is expressed is people want to borrow these securities. So the most recently issued ones or the ones that are deliverable into derivatives. So the rates on those are usually different, and they're lower if you look at it from the lending cash perspective. The rates on those securities are lower than others because they are preferable. And that's
right. And I just want to clarify, because this confused me in the past, so probably some people are confused. You're talking about the repo rates on the treasuries, not the actual yield themselves. So people talk, oh, the 210 curve is inverted. The 2-year treasury, the 10-year treasury, 2-year is at 4%, 10-year is at 3.5%. That's what the treasury yields. We are not talking about that. You are talking about the yield generated to borrow and lend those specific securities. So it's not the yield curve. It's different.
Yeah, exactly. So it is the repo rate, and the kind of simplest way to see it, to kind of conceptualize this is if the repo rates right now are around, well, before the Fed meeting yesterday, they were 3.8%. I don't think we've gotten the post-meeting numbers out yet. But let's say they were 3.8%. If there's a security that is in very high demand in the repo market, the rate against that the rate to borrow cash against that security might actually be like 2% or 1%. And that's just because many people want to obtain it, so they will sacrifice most of the yield on their cash in order to just get that specific security to use for hedging or for whatever other purpose they want it for. So that is, when that happens in the repo market, that's called a special, and that is the distinction between general collateral repo and specific collateral repo. So when some people just want to lend cash, they don't particularly care what security they're getting, and then that's general collateral repo. This does not happen. In specific collateral repo, you see this phenomenon, which is like the divergence of certain repo rates.
So general collateral is any treasury and any agency mortgage-backed security.
So this is actually kind of an interesting and weird niche of how like general collateral baskets develop. For the US repo market, yes, it's generally any treasury security, note, bond, floating rate note, bill, strips are all kind of one bucket. Then agency mortgage backs are a separate bucket. But yeah, these are kind of groupings of securities that develop over time, and I think it's just kind of vague consensus between market participants that decides these things. That basically the repo market decides, all of these securities are general in the sense that they're all kind of fungible between themselves in repo.
Yeah, and I just want to make a point, which is, some people may have heard the word repo talked about 2008, and they hear the word repo talked about now. In 2008, when people talk about the repo crisis of Lehman Brothers, they can't get financing because they were repoing they were not repoing treasuries. They were repoing private mortgage-backed securities, non-agency mortgage-backed securities, CDOs, equity tranches, leverage loans, all sorts of crap that that legit solvent banks were lending against. They say, oh, actually no, we want this is collateral is only worth 70 cents on the dollar. Oh, it's only worth 60 cents on the dollar, and then suddenly Lehman Brothers is insolvent. That is not what we're talking about. That sort of market of, correct me if I'm wrong, repo on non sort of pristine collateral is a shadow of what it once was. Now we're talking about like lending against treasuries, agency mortgage-backed securities, which are guaranteed by the government, right?
Yeah. And I mean, to some extent, repo against lower quality collateral does exist. It's not very large. And also these things change over time. So actually a really good example of this is the European sovereign debt crisis. So prior to the European sovereign debt crisis, in the euro repo market, sovereign debt was a general collateral basket. So all of those, like Italy, France, Germany, all of those sovereign bonds were considered interchangeable in the repo market. And that's no longer the case. Obviously, after the sovereign debt crisis, people realized actually these sovereign bonds are not all the same. We cannot interchange them in the repo market. If I want a repo backed by German bunds, that is not equivalent to a repo backed by other euro sovereign debt. So yeah, these things can change over time. It can reach a certain point of equilibrium, and then people realize, oh, this actually doesn't work, and yeah, the baskets change.
Got a question. Yeah. So when people borrow securities, is it most often to short them? So for example, you borrow a Greek bond because you want to short a Greek bond?
Well, yeah, that's kind of and this also kind of goes goes to relative value trading. So there are people who might observe kind of small divergences between securities on the yield curve, and they might say, oh, this one's actually like a little bit too expensive, this one's a little bit too cheap, so I want to borrow the expensive one, sell it, short it, buy the cheap one, kind of bet on them converging. Can also be used to hedge derivatives. So you go long a futures contract, for example, and then you borrow the underlying note in repo and you short it. But the other reason that people might want to borrow securities in repo is to sell them to customers. So like, for example, a dealer gets an order from a customer that wants this specific bond and they might not have it in inventory. So they go out into the repo market and say, oh, like, who wants to lend me this bond?
Got it. But what about when they say they want the bond back? Do they have to go to the customer and,
So I mean, this actually comes to the chart that you have on the screen here. So there is actually there's several things they can do. If for example a dealer sourced bond in repo, sold it to a customer, and then they need to manage that position going forward. So well, they can buy the bond from somewhere else. Maybe it's easier to find it on the market now, and they can just buy it and close out their repo position with a different bond of that same issue. The other thing they can do is just keep rolling it. So find someone else in the repo market who wants to lend it to them again. And the third option, which is kind of an extension of this, is to borrow it from the Fed. So the Fed owns a lot of treasuries. It has a huge portfolio, and it lends those treasuries out through the so-called SOMA lending facility to the primary dealers. And
that's reverse repo facility, right? Or that's that different?
So that actually happens at the same. I think it happens at the same time as the reverse repo facility, and it's kind of a closely tied program, but it's a little bit different. And the main difference being that the reverse repo facility is general collateral. So if you come to the reverse repo facility and you give them cash, you don't know what collateral you're getting back. Versus
so variable collateral but fixed rate, unless of course the Federal Reserve changes the rate as they did yesterday. At the December FOMC meeting, whereas SOMA is specific collateral, but the rate moves up and down. As you can see, this is the repo rate for on the run 2-year note lending rates, and it goes up and down, really close to 0 basis points, and then it goes up as high as 300 basis points in April of 2022 and as high as 400 basis points in September, October of 2022. So what is going on here? When looking at this chart, I was trying to place it on to Fed meetings, say, oh, people want to short a bunch of 2-year notes right before the Fed meeting, but it doesn't map on. Why is this happening?
Yeah, so actually I've gotten quite a few questions on this chart, and I can explain in more detail and like how to reconstruct it actually. So yeah, what we're seeing here, and like the spikes on this, is the SOMA lending facility is like you mentioned, not a fixed rate facility, is actually an auction. So the dealers come to the Fed and they bid for the securities that they want from the Fed's portfolio. And depending on how many bids are submitted, like how much of the security the Fed has, and like how many dealers are bidding, and like how much they need this security, the price can actually spike up pretty high. So that is what we see in some of these big spikes here that's like April, and then there was one really big one, I think that is in late September. And what happened there is there was a lot of demand to short these bonds, either because like they were very volatile and there were relative value opportunities opening up, and people wanted to participate in the trades. So they were demanding these bonds, or these 2-year notes from the dealers. The dealers did not really have enough of them, so they were going to the Fed, and they were bidding at a very high rate to obtain these. And that's what these kind of spikes are. And then at the bottom, when it's near zero, there's actually a 5 basis point minimum on this facility, so that they can't bid below 5 basis points. So when it's at 5 basis points, that basically means there's no demand, or there's no material demand.
Mm-hmm. That's interesting. Okay, so that is SOFR, and where within the interest rate complex, again with the ceiling, the floor is the lower Fed funds limit, the ceiling is the upper Fed funds limit, the target range that the Federal Reserve sets every FOMC meeting, and sometimes it can change between FOMC meetings, like it did in March, but that's very rare. Let's see. Okay, where within that ceiling and floor, and again, sometimes things go through the ceiling, sometimes they go through the floor, but where within that floor is SOFR, secured overnight financing rate? All right, so Kemen, what are we looking at here, where we've got SOFR in pink, Fed funds in green, the 1 month SOFR in red, and then effective funds rate in blue, overnight SOFR in black. And again, so SOFR is the overnight, but then you can have a 3 month SOFR where it's like rolled forward, right?
Yeah. So this gets into the connection between the money markets and the derivative markets that are based on them. So the money markets are generally between these big institutions lending cash and securities to each other. But these rates also kind of affect the economy as a whole, and people, broader participants in the market who are not even institutions, need ways to hedge against them. So that means there's a demand for derivatives. So the chart shows the overnight rates, so the Fed funds rate and SOFR, and then some of the derivative indices that have futures contracts trading on them, actually. So each one of these lines, or the red, green, and pink lines, are actually tradable. So you can go to the CME and, for example, buy Fed fund futures. They actually settle to the pink. That's the green line. The way this works are with averaging. So if you're looking for a derivative contract, you don't want a derivative contract on SOFR for a single day. For example, today, you generally want it over a few months, which is like, I'm going to keep my cash in a money market fund, and that money market fund yields a rate that is approximately close to SOFR. So I want to hedge the interest that I'll earn with a futures contract. And that the most common terms are 3 months and 1 month. Those are just like generally the I guess time intervals that you're averaging or compounding rates over when you're trading in these derivative markets. And the final thing to note here, I guess, is that these derivative indices are trailing. So they are backwards looking. As SOFR and the federal funds rate are updated, the derivative indices lag behind. And that is in contrast to, for example, something like a 3-month T-bill rate, which is forward-looking. It is like the maturity of the T-bill, or, for example, 3-month LIBOR is in the future. So you are looking at a forward term rate versus these are backward-looking. So that is an interesting kind of change.
Really? Why are they backward-looking? You can't. If I want to enter into a 3-month SOFR contract, it's got to be a forward thing, right?
Well, yes. So that is actually a very tough question for the LIBOR transition, which is usually as loan users, if you want to borrow money, you want to borrow money based upon a future rate. But since we don't know what the SOFR rate in the future is going to be yet, it's not really possible to settle derivatives against that future rate, or at least it needs to be better defined in order to settle derivatives off of it. So the futures on the CME are the numbers that they use are the trailing numbers versus actual loan borrowers who want to use SOFR might want to use a forward-looking value. So that introduces the concept of term SOFR, which is kind of a synthetic forward rate, and also kind of SOFR swaps and other kind of forms of forward-looking SOFR derivatives that can be created to kind of try to approximate a forward term structure. But naturally, SOFR and the federal funds rate do not have that property. So that's an important nuance.
A lot of what you said, I'm happy because it's a natural transition to a topic of the Eurodollar transition from LIBOR to SOFR. LIBOR is a benchmark rate that so many things are pegged against. Pretty much everything is currently pegged against. It has been for many years. There was a scandal where it was revealed that the bankers were sort of cheating and scamming the LIBOR thing. So there's this commission set forward to, okay, actually we'll have it be a new thing. It won't be LIBOR, it will be SOFR. That transition is set to happen early next year, or I want to hear all about it.
The LIBOR transition, and I don't think this is finalized yet, but there's like a fairly good plan for it, is going to happen in mid-April of next year. And that is because the LIBOR rate has been deprecated and they're going to stop publishing it. So all of the futures that are based on LIBOR need a new rate to base off of, and that's going to be SOFR. So basically, at some point in mid-April of next year, the CME is going to take all open Eurodollar positions and convert them into 3-month SOFR positions with some adjustments that I think they're still kind of in the process of working out. And yeah, eventually, basically, or after that, all of those positions will be SOFR positions, and the kind of official 3 months or the only really 3 months kind of short-term interest rate contract for the US will be the SOFR contract. So that's going to be a very big event for the market. People are already or fairly well prepared, I would say. Like there have been various moves to encourage people to start using SOFR already and to transfer positions early before the transition happens to kind of minimize the shock of that. But yeah, that's definitely going to be something to watch over this spring as it gets closer. Like, first of all, like what the final details of like the conversion adjustments are going to be, and then like how big the conversion is actually going to be when it happens, and how much is going to be converted earlier just by people wanting to move over on their own.
Right. Yeah. And how different are SOFR and LIBOR? LIBOR is offshore, so officially not within the remit of the Federal Reserve, and really not within the remit unless the Fed can extend swap lines, but that's really only in a crisis situation. And so LIBOR is more risky, right? Because it's lending on an unsecured basis as opposed to offshore, We saw what happened offshore with the Bahamas. I'm just kidding. And so SOFR is secured. LIBOR is not. So LIBOR is more risky. So does LIBOR trade at a premium, meaning LIBOR rates are higher?
Yep. Yeah. So, and I guess this is the kind of way to think about kind of between LIBOR and SOFR, because, well, in the past, maybe LIBOR was a more active market, but now there's relatively little actual borrowing or intrabank borrowing and lending in London at the LIBOR rate. Like it's
yeah. So sorry. So this blows my mind. Okay, so SOFR is used a ton in the spot market of, overnight I'm going to borrow Treasury, I want to borrow cash, I'll post my Treasury as collateral. But the futures market does not exist yet, or it's very nascent. Whereas LIBOR, the futures market is huge. It's the biggest market in the world, but the actual spot market of people buying and selling is kind of a dead market.
It's tiny. And I mean, to kind of update that to a certain extent, I would say the futures markets between LIBOR and SOFR now are more equally sized. Like SOFR futures have gotten a lot bigger just recently over like the last couple months to a year. And now they're like at a comparable size to the Eurodollar market. But yeah, up until kind of earlier this year, that was definitely true. Like the SOFR spot market was very big. The futures market was very tiny, and Eurodollar was the other way around. Yeah.
Right. Okay. Sorry. I got confused because earlier you said that 3-month SOFR refers to a past and you can't do a future.
Well, yes. So that is an important point. So, and that is actually a little bit confusing when you look at how the futures are named. So, for example, the Eurodollar December 2022 contract, it expires in December of 2022, right? Because whatever the LIBOR rate is at the expiry date, they will just take that rate and they will mark the contract to it. However, the SOFR contract for December of 2022 actually expires in March of next year. And that is because it covers the same period of time. So the LIBOR contracts covers the rate is effective between December and March, and the same thing for the SOFR contract, but the SOFR contract matures at the end of that period. So they have to wait all the way until March to get all the SOFR data in. And then at the end of that, only the contract matures. So they're both called December contract, but there's a 3-month offset always between Eurodollar and SOFR. So yeah, and that's part of the conversion too. When the contracts are converted, they are converted to a contract that matures at a different time. So it's going to be really tricky for the CME to get this exactly right, but they're working on it. Yeah.
This is probably a little bit before both of our times, Kemen, but what about the fear that 22 years ago, as soon as it went to the year 2000, computers would just stop because they didn't know how to do something? Are there similar fears that the LIBOR to SOFR transition, like the financial markets will just stop?
I mean, I think there's always like something like that. Like you could say it's like a very tail risk that just something goes horribly wrong. The market basically breaks the next day. But I'm sure they're doing a few things to mitigate that. The one thing is like they're doing the transition over the weekend. So the way this is going to work is like the Eurodollar contracts will close at the market close on Friday, and then they will do work over the weekend. And when it reopens on Monday, they should all be SOFR futures going forward after that.
That's going to be a busy weekend.
Yeah. But yeah, and I mean, there's always this kind of risk, and it's kind of the same thing people were talking about with like the Ethereum merge, where like there's this worry that like the whole thing might just go horribly wrong, but it didn't, and like fingers crossed, the Eurodollar transition will similarly be uneventful.
But just my own personal curiosity, are Fed funds futures, which are by far the contracts that I'm most familiar with, are they also 3 months in advance or? No.
So Fed funds futures contracts are monthly. So
yeah.
Yeah, and that's kind of the difference between the two tenors. So there's the 1 month tenor and the 3 month tenor. There's also a SOFR contract in the 1 month tenor, which is like basically exactly the same as the Fed funds contract, but it's SOFR, which is actually very convenient because you can trade the spreads between them. But yes, these 1 month contracts are also kind of trailing. They so for example, the December Fed funds and the December SOFR contracts, they will mature at the end of this month, and they reference the rates that already occurred, right?
Okay, that makes sense. Yeah, so now let's look just at the spread between EFFR, effective Fed funds rate, and SOFR. Before 2020, let's see, what does this mean? SOFR was above EFFR, whereas now EFFR is higher than SOFR. Why is that the case? I guess, let's see. EFFR is an unsecured rate. SOFR is secured. So it would make sense for EFFR to be higher than SOFR. So I guess my question is, why was EFFR ever lower than SOFR? Yeah.
So that's and this I guess this chart was kind of the big center of the post, and what I kind of wanted to highlight here is the whole thing really depends on the balance between cash and collateral in the system. So these are all rates between kind of there's not really much material credit risk here. All of these dealers, all of these banks that participate in these markets are extremely well capitalized and stable. So the primary difference is the presence or the absence of collateral. And the way that affects the market is when cash is very plentiful and collateral is scarce. The federal funds rate is relatively higher since it's less affected by that condition. Since the federal funds market is mostly banks doing this arbitrage that we talked about earlier, they do not really feel the effects of the cash versus collateral balance. Meanwhile, in the repo market, this has a very real effect. Like if there's a lot of cash, there are certain kind of regulatory limits to banks and dealers' balance sheets, so they might not want all of that cash. They offer it at a low rate. So the SOFR rate is much more sensitive to this balance versus the federal funds rate, since a lot more of it is made up of arbitrage, is less sensitive. So that's the main thing that is moving this chart, is just like the balance of the relative scarcity of cash and collateral. And since
sorry. So now is there more cash, or so the EFFR SOFR it going from positive to from negative to positive and then going up, even though it's only 5 basis points? Does that mean that too much cash or too much collateral?
So the way it is on this chart right now, the positive values mean generally a glut of cash. So that means there's a lot of cash. SOFR is low because people are lending that cash into the repo market and sacrificing the rate, like accepting a lower rate. While in the Fed funds market, it is kind of more isolated from all that, since the Fed funds market is small and is mostly these arbitrage trades going on. So the Fed funds market is just less affected, and that's what's going on here. The final thing to note about this chart is this is actually a tradable spread. So this is the 30-day average spread between the Fed funds rate and SOFR, and you could actually trade this if you go into the futures market and you buy one of the futures and sell the other, you get exposure to this line directly. So this is actually not just kind of a theoretical thing. This is actually something you can get access to through a tradable product. And if you kind of have some views as to like where repo rates are going and like where the balance of cash and collateral is going to be in the system, yeah, you can express that view and you can try to make money trading this.
Right. And so just to give people, right now that's that spread is at just below 5 basis points. So let's call that 5 basis points. 1% is 100 basis points. So if you put $1,000 into this trade, over the course of a year, you would get 50 cents. So per day, you would get 50 divided by 365, or maybe it's fewer days, whatever. So you get way less than a penny. So this is you'd have to have a lot of balance sheet to make money doing this.
Yes. So if you were going to kind of arbitrage it directly, that's very costly for you. If you are going to do it in the futures market, then like you're effectively like levered up. So you have like leverage against the spread. But if you're going to for practical purposes, it's not really all that meaningful. It's a few basis points. It's if you're a cash investor, you're not really going to know the difference between EFFR and SOFR.
And Kemen, what is an overnight index swap, sometimes called OIS, and what is the spread between FRA and OIS? What does that mean?
Yeah, so an overnight index swap is just a swap based off of an overnight rate, so off of EFFR or SOFR. Either of those two have OIS traded off of them. And that just means, basically a contract between two counterparties. One of them pays the fixed rate, one of them pays the floating rate as it changes, and the market expectations of like the future value of the overnight rate determine the price of the swap. So that's OIS. And then what is FRA OIS is there are, forward rate agreements, which are a type of swap, really, but they are based on LIBOR. So basically, FRA OIS is another way of saying the Fed funds or SOFR spread versus LIBOR. So that's a measure of credit risk. That's a measure of kind of liquidity in the banking system, and it's an important thing to look at and correlated with like Eurodollar futures also. So it's a spread that has like a lot of knock-on effects everywhere.
Right. Thanks. And that's similar, not the same, but similar to the TED spread, the spread between Eurodollar rate or LIBOR and treasuries. And it's amazing. We've talked all about interest rates. We haven't really talked about treasuries at all. So where within the rate complex is treasuries, securities of the, in this case, US government? And the chart we're showing now shows the SOFR swaps curve over the U.S. Treasury curve in red. And what does it mean when the 10-year SOFR swap is below the U.S. Treasury? Perhaps it's a unsophisticated interpretation, but here it is that why who should be able to borrow money at a lower rate than the U.S. government? That doesn't make sense. The government is like the should be number one, right?
Yeah, so there are kind of various reasons for this, and this is kind of a phenomenon called negative swap spreads. So the spread between swaps and treasuries is called the swap spread, and there are like various arguments why treasuries should be lower. Namely, as you mentioned, like the U.S. government is risk free, and everyone should want to lend to the U.S. government at the lowest possible rates. The other, I guess, argument to this is that they should be about the same. If you were just coming at this from a theoretical point of view, is like, the swaps curve is the forward expectation of overnight rates, and then the treasury curve should more or less line up with that. So swap spread should be low to zero. But in reality, it is just a market rate, and it depends on like the issuance of the treasury and like what buyers are actually there and willing to bid for it. And there are different things that affect that. So now actually swap spreads, since when this graph happened, the swap spreads have actually gotten wider in the, as you mentioned, the kind of confusing direction of treasury yields being higher. And that is a reason I believe that might be so is because of the inversion, which is that short-term treasury rates are just so attractive that investors are not really as interested in term rates. And that means that kind of term treasuries are kind of trading at this somewhat paradoxical discount to swaps.
I understood every single word that you just said, but I didn't really get the point.
Oh, so I guess the point is about the inversion, right?
Yeah, I get that, but I really don't understand like the significance of these two rates. Is the difference between them, is that the term premium?
Well, it's the difference is called is the swap spread, but yes, it's related to the term premium. So that the term premium kind of, depending on what your model is, there are various ways of thinking about the relationship between the swap spread and the term premium. But I guess kind of the most simple kind of TLDR explanation of this, of what the inversion has to do with the spread, is as the curve gets more inverted, dealers have to buy more of the longer term bonds. Since like real investors don't necessarily want to buy them, they are being absorbed by dealers. And since dealers fund in the short term mainly, their forward kind of cost of capital is the swaps curve, or like the expectation of future interest rates. So in order for dealers to absorb these treasuries, they need to be offered a premium to their cost of funding effectively. And that's one kind of oversimplified but possible way of thinking about why this happens.
Okay. That makes sense. So then what's the term premium?
Well, the term premium, and some people will say like the term premium is just kind of a theoretical number. But yeah, the term premium is supposed to be another way to express this, which is based on just the treasury curve, which is like the expected yield on rolling, for example, a 1-year treasury bill 10 times versus buying a 10-year treasury bond.
Yes. Okay, but rolling it based on the forward rate of the treasury, right?
Well, yes, it's kind of the expected rate of rolling it. And like the term premium is not a directly observable quantity. It's like something that you have to kind of estimate from regressions as to like what the expected rate of like rolling something is versus buying the term rate. Yeah.
So, Kemen, this interview is going to air a week or two after we're filming it, and we're filming this on December 15th, the day after the FOMC meeting. So I'm actually really glad that we talked about evergreen topics that, hopefully will have as much value to people listening a year from now as much as they do now. Unlike if we had just talked about the Fed meeting on December 14th, which sort of, wanes in importance over time. But real quick, what were your thoughts? And what do you think about how high the Federal Reserve can hike now?
Yeah, so I mean, in terms of the headline result, I guess the 50 basis point hike was pretty much as expected, like what the market was pricing in. I don't think anyone was really surprised by that. The more surprising thing, and the thing that I was like watching in more detail, is the expectations for the end of 2023. So I think a lot of people are also commenting on this. The Fed came out with a new dot plot, a new kind of set of rate projections, and they were pretty ambitious for the end of 2023. I think the median FOMC member, don't quote me on this, but I think it's above 5% for the end of 23.
Yeah, 5.1. Yeah. And sorry, at the end of, so Fed was implying 5.1 from the dot plot. At the end of yesterday, after day of FOMC, the market was implying about like 4.8 by then, and now it's 4.9. Although honestly, yeah, by the end of December 2023, it's still actually 4.5. I was talking about the terminal rate. But yeah, now it's 4.5. So there's like still a 60 basis point difference. And I guess the sort of easy interpretation is the market doesn't believe the Fed.
Yeah. And I mean, I think that is like something that will definitely evolve as next year goes on. But I definitely agree with you here, and was watching this closely, is like, yeah, the futures market is definitely to some extent, or at least if you take it at face value, fading the Fed. It's saying like, yeah, we don't think rates will be that high at the end of next year. And in the options market, you can even see this like more vividly expressed. Like if you look at for December 2023, if you look at like a call spread that targets 2% to like 1.5% on the federal funds rate, which is like absurdly below what they project it to be, like that call spread is not necessarily cheap. Like you're paying 10% or something of the max payout for that. It's like the market does not think like 1.5 to 2% in the end of 2023 is like an impossible event. It's like it's being somewhat priced in, and I think it's going to be interesting to see if that evolves and if like the probabilities start shifting more towards, like the Fed is going to cut by the end of 2023. They obviously in their forward guidance have said this, they will not do this, but yeah, the market is assigning like some non-zero probability that they change their mind at some point.
Yes, and cutting to 1.5% by the end of 2023, that's not just a soft landing. That is like, a doomsday scenario, a severe recession that says, oh, wow, the Fed says we tightened way too much. We are easing, that's something bad would have to happen for that to happen. And you're saying that probability is being weighted somewhat highly by the market. So the market is, kind of,
Yeah, I mean, the market definitely doesn't see it as in any sense likely, but I would say like likelier than the Fed. Like if you ask the Fed, what is the chance that y'all are at 1.5% next year or at the end of next year, they say no chance.
And more likely than a normal distribution would suggest. Skew.
Yep.
Yeah. Okay. Cool. So Kemen, it's been great getting you on talking about all this stuff. I am someone who, talks about these things pretty regularly, and it's, I'm getting that feeling of a headache when you just have so much information come into you that you don't understand. And you think about these things at a really high level, and I hope my audience really appreciates how rare this is. Very impressive, especially given how young you are. Probably similar to my age. You were into crypto though too. Okay, so that's interesting. You actually work at a crypto firm now. What drew you to crypto? You can answer that question. You could also answer, what are the interesting parallels you see between crypto? Like, are there spreads? Oh, the Ethereum's borrowing spread versus the Bitcoin borrowing spread. That tells me XYZ about the market, in the same way that the SOFR EFFR spread or the TED spread or the forward rate agreement OIS spread tells me ABC about the market.
Yeah. So actually, this is a great to talk about. And Good to update. So since we last talked, I started a new job at Gauntlet. We are a risk management company for DeFi. We provide kind of risk management services, advisory for many of the biggest lending protocols in DeFi. And I think, things that attracted me to this job is a lot of innovation. Like obviously there is. DeFi did not exist a couple of years ago, and now there's a lot of lending and trading that you can do. That's very interesting. But another thing is, and I think this will be kind of very important in the next development cycle of DeFi and the crypto markets in general, is interest rates. Like DeFi has interest rates. If you go to any of the big lending protocols like Compound, Aave, so on, they will quote you interest rates, and they need models to determine this. So actually, one of the things we've developed recently at Gauntlet is models to help optimize this, to manage risk, to basically tell protocols where they should set their rates in order to optimize the functioning of their market. So I think there's a ton of work left still to be done there. Like interest rates in DeFi are still very, very early days, and I'm kind of excited to keep doing this and maybe come back to talk about it if you'd like.
Yeah, definitely. Okay, so why is there yield in crypto? Here's the one thing I understand about, like I fully understand about yield in crypto, is in a bull market, people want to borrow dollars so that they can buy more Bitcoin or Ethereum or whatever. So they want to be leveraged long. So they borrow stable coins, which are like dollars, but crypto versions of dollars. And so hence the demand to borrow stablecoins would be high. Therefore, yields on stablecoins would be higher than a treasury bill or something. So you can get an 8% yield on a stablecoin because everyone wants to get uber long in a bull market. Now, is that 8%? If treasuries are at 0 or at 1% and stablecoins are at 8%, there's a reason for that. There's a risk, both in terms of the stablecoin itself, the protocol, as well as credit risk. But that makes sense to me why the yield would be so high. But why would there be yield on Bitcoin other than for people to short Bitcoin? It seems like in a bear market, the only demand for people to borrow Bitcoin, to short Bitcoin, would be in a bear market.
Yeah, and I mean this is like to some extent also what we've observed throughout DeFi is like there are certain sources of yield that you could call more or less consistent, which are like, for example, staking yield. So, for example, if you stake in a proof of stake kind of system, if you, for example, stake Solana and you're providing your assets to provide security to the network, you are compensated for that in some way. But there are also other forms of yield which are more based on fees. So that would be, for example, if you are providing liquidity at like a decentralized exchange. And these are very different, right? So there's a different risk profile and there's like different variability to this. So I think another part that is very important here, and as like interest rates in DeFi kind of like develop further, is like actually developing a clear classification as to like, okay, these yields are actually comparable. So for example, staking to staking is comparable versus like liquidity provision is like actually a different thing. And like these yields are sourced in different ways, right? Effectively.
Okay. Yeah, so staking is something that I don't really understand because it's not a financial understanding; it's a technological understanding. But there's no real, to me, analog of staking in TradFi. Or maybe go ahead, please.
I would say to some extent, like within TradFi, within like US treasuries are the analog of staking. When you stake a proof of stake coin, you are locking your assets to provide security to the network effectively. And when you buy a US Treasury, you are locking your dollars to provide money to the US government. Not a perfect analogy, but more or less.
That's a really good analogy. I did not think of that. But there are some more analogies that fit even closer than that, such as borrowing stable coins to buy Bitcoin is the same as borrowing dollars to buy Apple. Likewise, borrowing Tesla to short it, you borrow something you don't have and then you sell it and then you book the profit hoping that you can buy it back at a lower price. You could do that with Bitcoin. Borrow Bitcoin, sell it. It's the exact same thing. And that demand and supply affects the yield on things. So, Kemen, I feel like at the scene of the crime of this year's bear market in crypto is yield, okay? Because at the tail end of 2020 and all of 2021, the big theme was yield. Like, oh, don't just buy Bitcoin and have it go up 5 times. You can generate yield on it. You can do securities lending. And there were high-profile blowups that were really, really bad examples of risk management of Celsius. You get 20% from this loan. Oh, FTX, you get a certain yield on this. Terra Luna, it's 20%. There's basically no risk, right? There was risk. And what's the question I want to ask? Let's see. Yeah, where did the yield come from? Where did people think the yield come from, and where was the problem? Where did the yield actually come from? And the difference between those two is the problem. So,
yeah. Well, I mean, I think there's like there are two aspects to this, right? So there is kind of DeFi, which is mostly like or pretty much exclusively over collateralized lending. You go to a lending protocol and you deposit some collateral and you borrow stablecoin from it, for example. And that loan is liquidatable instantly, like if you default. And currently, at least, like those DeFi loans generate like a fairly low rate. They're actually somewhat lower than US dollar rates. But and then there's also the other form, which is like more CeFi yields, which are things like Voyager, Celsius. They lend out your coins unsecured to like a market maker, and hope that the market maker returns them at some point.
Didn't Celsius say that it was securitized? They said it was securities lending, collateralized, right?
Yes. So in a sense, I think what happened, and this is obviously like a huge oversimplification, is like the lack of collateral in these types of centralized lending basically led to a huge credit bubble, and that like lenders could lend to the riskiest crypto hedge funds at 20% and then turn around and tell their depositors, actually, this is really safe.
But sorry, if let's say, I don't want to say if I'm Celsius because I'm not, but if Celsius was lending Bitcoin to some hedge fund that's really risky, and they're generating 20% on that yield, isn't the hedge fund giving them the money? Or they're literally not giving them the money. They're just giving them the Bitcoin and then saying, oh, we'll give you the money later.
Yeah, well, if it's under collateralized, you just assume.
Okay, I guess by definition,
they take the coins and then tell you they say, well, we'll pay back at 20% rate, but that's a very high rate, but it's definitely not safe. And that's a big problem of a credit bubble, is that you misprice risk. Basically, you think something is really safe when it actually isn't.
Okay, so a lot of under collateralized lending in centralized finance, CeFi. A lot of what goes on in DeFi, decentralized finance, you said, is over collateralized. However, Kemen, I know from traditional finance that just because something is over collateralized doesn't mean that it's risk free. As a matter of fact, a lot of the like CDOs, I forget what they stand for, default obligations, whatever, collateralized debt obligations, CDOs, were over collateralized by subprime mortgage. So for every $100 that they borrowed, they had 120 in assets. The only problem is the 120 in assets was actually worth $5. I'm exaggerating, but couldn't there be a problem if I lent some money and it's collateralized by blank coin or whatever, and blank coin falls dramatically and you can't sell it. I mean, that is a risk, right?
Yeah, definitely. And I mean, DeFi lending is definitely far from risk-free. There is all kinds of smart contract risk, kind of liquidation risk, and all the collateral is also very volatile, since obviously most people are using volatile tokens as collateral, and their prices can move very quickly. They might not be liquid. They're also, as we've seen this fall in events like the Mango hack, these collateral values can be somewhat intentionally manipulated in order to extract value from a lending protocol. So all of these things are risks, and all of these things are things that Gauntlet studies and that we work on and we try to help our clients mitigate. So that is very kind of relevant to my current work and what we do as a company.
So I'm going to ask a question that I don't know if it's the ultimate softball question or if it's the ultimate hardball question. But if FTX had been a client of Gauntlet and had hired Gauntlet to help them with the risk management, what would you have done to help them out?
Well, I'm not sure. Well, I kind of got to clarify. We work with DAOs, so like we generally would not offer a product for centralized exchanges, at least not currently. They are kind of structured very differently, and I don't know how we would even kind of
got it. Although technically there was an FTT DAO, and people who were involved in the FTT DAO were called BFFs, best friends of Sam Bankman-Fried. That's not a joke. You can look up FTT DAO.
That's incredible. But yeah, I mean, it's like, obviously, if a very hypothetical case that this would happen is like, well, obviously the collateral is bad, right? Like and this is something we study carefully, and we have like a lot of market data on this, on like the liquidity of different types of collateral, and we would have just told them from like basically walking in the door, yeah, this collateral is no good. Hypothetical, obviously, that would never happen.
Maybe you probably wouldn't have accepted them as a client. So what's the typical risk that a DAO has what's the typical risk of a DAO has? And then what's the typical solution that you think, oh, if you do X, Y, Z, you can mitigate that risk? For
lending protocols specifically, the biggest risk they're obviously dealing with is like insolvency risk. They have they take collateral and they have rules to liquidate loans that become under collateralized. But sometimes this doesn't work perfectly. Prices move too quickly. Liquidity is spotty, and they can't liquidate the loan quickly enough. So that's insolvency risk. And then this also comes around to the concept of kind of DAO treasury management, is that DAOs, when they operate, they generate fees, and they retain some of these fees as reserves, and they need some way to kind of manage these assets in order to have reserve funds or some kind of backstop to protect against these insolvencies.
Right. And what I think you mean, and correct me if I'm wrong, is by reserve management is you have a ton of cryptocurrency assets that your native token, and you need some way to sell that to have dollars to pay your expenses, because people, the building that you rent from, they don't accept blank coin. So you have to sell them in a way that doesn't crash the price, basically. And this goes way back, if people read, right? Is that what you're talking about?
Well, I mean, treasury management is just kind of a general optimization problem, I guess. It's like,
okay.
Yeah, it's like you might have certain needs, like, and some of them may be paying like costs in dollars, and you need to sell some of X token in order to obtain dollars to pay those costs. And others maybe you might have to cover liabilities in tokens that your like protocol might incur at some point.
Got it. Okay. So it's more complicated than that. Kemen, we've been going a long time. I want to be respectful of your time. So, what would you say was your key learning from FTX? And then tell us about a certain, I don't know if Gauntlet has a white paper, and tell us about that, and we'll be happy to include it in the description.
So what was the, I guess, biggest learning from FTX? I mean, yes, it's like the market can be horribly wrong about things. I mean, like up until like the very last minute before they filed for bankruptcy, there were many prominent people, and like many people who I respect and still think are very smart, who were just wrong about it, and that's fine, and that's just kind of part of the way markets are, and yeah, I guess it's a lesson for everyone that like even very unlikely things like this can occur. In terms of things to plug for Gauntlet. So I am my job is within marketing. So I'm a content manager. I write most of our blog posts and materials. I think the one thing I will plug is check out our website at gauntlet.network. Check out our blog on Medium. Check out our content. And hope to be doing a lot more of this and bringing more interesting kind of interest rate stuff to DeFi as well.
Yeah, I mean, you're a really interesting guy, Kemen. It's rare that someone knows as much about TradFi or crypto. I mean, one of them, but to really know a lot about both is very rare. I'm very jealous. Kemen, can I plug your Twitter handle, or is that a private information?
Oh no! Please. Yes,
okay. People should follow your work on Twitter at AnalystDC, and your Substack is called dcchartbook.substack.com. So most or all of the charts that, if you watch us on YouTube, you saw were from that Substack, which is excellent. Kemen, thanks so much, and hope you have a great rest of the year.
Yeah, thanks so much, Jack.